This is the number one question that comes up a lot, and that's the debate between Roth and traditional for the 401k. But in this video, I'm going to focus specifically on the TSP for federal employees and military members. When should you choose Roth TSP? And then when should you choose a traditional TSP? So let's dive into that. And the first thing you need to understand is the marginal tax rates. The 2025 marginal tax rates were just released by the IRS a few weeks ago, and this is just the federal income tax. But if your combined marginal tax rates between federal and state are, let's say, under 25%, I would say you get more out of from the Roth TSP. Let me touch on the military pay first, and I'll leave chapters in the description below so you can navigate the video yourself. So if you're enlisted in the military, I would argue that investing in Roth would be more beneficial. Even at the pay grade of E9 with over 30 years of service, your taxable income is around $107,000 a year, and that's before the standard deduction of $15,000 for a single individual or $30,000 for a married couple. And that income sits around a 24% marginal tax rate for single individuals and a 22% marginal tax rate for married couples filing their taxes jointly. And that's not counting your bonus or other incentive pay that is taxable, like if you get flight pay and stuff like that. And because your BAH and BAS are not taxable. And I would argue that most enlisted folks would benefit more by investing in the Roth portion of the TSP, unless they have a spouse who makes significantly more income in the private sector or in the government sector that puts them at the 32% marginal tax rate right here, right? And then I would look into the traditional portion of the TSP. It really depends on each household's financial situation. And you don't have to always do entirely on Roth versus traditional, because next year you're going to have 23,500. That is the maximum. And you can literally split that in half between Roth and traditional if you want to. And that half of that TSP, if that's going to lower your taxable income from 32% to 24%, and then you can put the other half into Roth. I mean, that's one strategy that you can do. And for the officer side, it's not until you're single or unmarried 08 officer, which is a rear admiral in the Navy or a two-star general in the other branches, to be close to getting above the 32% marginal tax rate. And this is all based on the 2024 pay chart. Let me see if I can pull that up here. I thought I had it pulled up in advance. Pretty sure I did. Yep, I did. So if you can't see it, you can always pinch on the YouTube screen and then take a look at the active duty chart. But this is based on the 2024 pay chart. So unless you're a 3-star or 4-star general or admiral watching this video, which would be awesome, and you're about to hit $17,000 in monthly base pay, I would still strongly argue that the Roth TSP is the way to go. But again, it depends entirely on your complete financial situation. What is your total taxable income with your spouse? Do you have any other income sources like real estate or dividends from your investments, right? And for federal employees, you're most likely in the 24% marginal tax rate if your income is less than $212,000, and that's adding the standard deduction of $15,000 for single individuals. And I would pay attention to this more if you're a GS 14 or 15 or in the Senior Executive Service or SCS in the DC or Maryland area, where you make significantly more money because of the locality rate. If you're somehow approaching the 32% federal marginal tax rate here, or a combined tax rate of 25% or more with federal and state, then you could, like I said earlier, partially contribute to traditional TSP to lower your taxable income. Otherwise, the tax rates are still significantly lower, so the Roth contribution can still benefit in the long term. And keep in mind that this calculation does not include your state income tax. And if you're married and filing your taxes jointly, your 24% federal marginal tax rate is much higher than of a single individual. So if your income is above $424,000, after adding the standard deduction of $30,000, you're still going to be in the 24% marginal tax rate. So let me run some scenarios here and see if it's going to help you figure this out. Okay. So with the Roth TSP, I'm going to first do the single individuals, and then I'm going to do the married couples later on in this video. So let's assume that you are 35 years old and single, and your gross income is going to be $100,000 a year, which is really good income. And after your standard deduction of $15,000, your taxable income is going to be $85,000 for the 2025 tax brackets. So the first $11,925 will be taxed at 10%, and the next $36,550 will be taxed at 12%, and then the next $36,525 of that $85,000 income will be taxed at 22%. So for the Roth TSP, because you're paying the taxes on the contribution now, you want to assume that you're paying at the highest marginal tax rate. So in this income scenario, it's showing a 22% marginal tax rate. That makes sense so far, right? So let's say you're contributing $15,000 a year in 2025 to your Roth TSP. So multiplying that by 22% in the marginal tax rate is going to be $3,300. You're not going to get billed for this or anything by the IRS, but you're essentially paying $3,300 upfront to the IRS when you make the Roth TSP contribution because you're paying your taxes upfront, right? And if you look at it another way, you just don't have the tax savings of $125 every 2 weeks as a federal employee or $275 a month if you're a military member. But what's awesome about the Roth TSP is that the money you put in will grow tax-free, and then you can withdraw your contributions, earnings, and interest tax-free. So assuming you're 35 years old and starting with $15,000 a year in Roth contributions every year with a 2% annual inflation rate or inflation increase in contributions, you could grow your Roth TSP to over $1.4 million in tax-free money if the market performs an 8% average annual return. You can use the TSP calculator from my website at firesignchat.com/resources to calculate your contributions. So the bottom line is that you're paying that tax upfront to that $1.4 million. So that $1.4 million can become tax-free when you turn 59 and a half. So what can you do with $1.4 million in tax-free money? Well, keep in mind that I adjusted a Roth TSP with a 2% annual increase in inflation, okay? So let's assume that you're retiring in the year 2025 with your federal retirement income at, let's say, $30,000 a year, okay? And your Social Security pension at, we'll call that $20,000 a year, and you have some traditional TSP with over $13,000 a year because you have your TSP employer match that went directly to the traditional portion of your TSP. So your total taxable income, we'll just call that $63,000, and your standard deduction is $15,000 under the 2025 tax bracket. And obviously the standard deduction will increase with inflation in 25 years, but I'm going to keep it simple by using the 2025 tax brackets and assuming that you're not over the age of 65 because there would be more standard deductions if you were over the age of 65. So anyway, the first $11,925 again will be taxed at 10%, and the next $36,075 will be taxed at 12%. And most retirees would like to pay less in taxes in retirement. I haven't heard a single client or anybody in the comment section that they will love to pay more taxes when they're retired. No one. Okay. So the 12% marginal tax rate is a good target rate for someone with $60,000 a year in taxable retirement income because every dollar after $63,475 will be taxed at 22%. So if you want to retire with $100,000 a year and pay 12% in marginal tax rate, this is where the Roth TSP comes into play. Using the same scenario with $1.4 million invested in the Roth TSP, the 2% withdrawal rate will give you $28,000 a year in tax-free money. A 3% withdrawal rate will give you $42,000 a year in tax-free money, and a 4% withdrawal rate will give you $56,000 a year in tax-free money. Did you hear tax-free? And so depending on how your portfolio is diversified and grows annually, right? So it could go to 1.4 million. Maybe you're more aggressive and gets to 1.5 million. So let's just use this scenario. You could have a 2.6% withdrawal rate from that $1.4 million Roth TSP. And if you add that up to the pensions and traditional TSP, you can have $100,000 a year paying 12% in marginal tax rate. Do you see how you pay so much less in taxes in your retirement with the Roth TSP, right? Let me give you another example. So for those of you who are married or plan to be married by the time you're retired. So let's go through this. Let's assume that your high 3 average salary was $150,000 a year, and you want to retire with $150,000 in the year 2025 as a married couple filing your taxes jointly. Let's say you're gonna collect $35,000 a year in pension income, $25,000 a year for each spouse from Social Security, and $40,000 a year from traditional TSP and your spouse's traditional 401k, your total gross income will be $125,000. And I'm going to use the 2025 standard deduction for married couple at $30,000. So your taxable income is going to be less than that at $95,000. So the first $23,850 will be taxed at 10%, and the next $71,150 is going to be taxed at 12%. Your total taxes as a married couple are significantly lower than single individuals. So your gross income of $125,000 will only put you at a 12% marginal tax rate. And the first dollar of $126,950 is going to be taxed at 22% for the year 2025. So you and your spouse could use your Roth TSP. I'm going to use the same example of 1.4 million to supplement the remaining $25,000 in retirement income to maintain the 12% marginal tax rate. That 1.4 million is completely tax-free after the age of 59.5. Just withdrawing 2% of that 1.4 million will give you $28,000 a year from the Roth TSP, and that'll give you $153,000 a year in retirement income, but still maintain that 12% marginal tax rate. A 3% withdrawal rate will give you $42,000 a year in tax-free income, or $165,000 a year in retirement income, while still maintaining that 12% marginal tax rate. How incredible would that be to live on $150,000 on a 12% marginal tax rate, right? But when is traditional TSP right for you? And I've been talking about Roth TSP for a while. It really depends. But first, you need to be able to compare your current income and your retirement income. You can go to ssa.gov to get the Social Security income estimates, because depending on your combined income in the future, you're going to have to pay income tax on up to 50 to 85% of your Social Security benefits. That could change with a new administration coming in in 2025. And President-elect Trump already said that he's looking to cut Social Security benefit, the taxes on the Social Security benefits. So we'll see what happens with that. And what is your federal employee pension going to be? And are you also collecting your military pension? There are a lot of who used to serve in the military, and then now they're federal employees. They retire from the military, they get that pension, and they're looking to collect another pension with the federal government as a federal employee, right? And those are all taxable income. So you need to calculate those first. And do you have any other income sources like real estate or business? They're not as common, but they are very possible. And is your current income 30% or more in the marginal tax rates? Chances are you'll have a lower tax rate when you're in retirement, like I showed you earlier. Your expenses will most likely be lower, and you're probably going to do what you can do to lower your taxes from 32 to 24%, right? You can always split between traditional TSP and Roth TSP depending on your total tax rates. And if you're close to your retirement age and you're trying to have more take-home pay because you're trying to save more cash, traditional TSP might be right for you. You just need to be aware of the required minimum distributions when you turn 73. So if you've been saving for a while in the traditional account and you want to avoid being in a higher tax bracket because of the RMDs, making a Roth contribution may be better if you're close to 73. And I know these are all general guidelines, but ultimately you have to decide if getting a tax break now or later makes more sense. So if you're still trying to decide what's right for you, just remember that Roth will always be traditional if you still have a long time horizon until your retirement age. And if you have more assets in your traditional accounts than in Roth accounts, then putting money in Roth could be a hedge against future tax increases, right? Now, as you can probably tell, I spend a lot of time calculating my Roth contributions. And no matter how much I compare with the traditional 401k, traditional TSP, or traditional 403b, Roth has always beaten traditional because of the tax-free money in retirement and the tax-free growth. The traditional argument, no pun intended, is that if your income is going to be higher in retirement, you should contribute in Roth. My argument, on the other hand, is that I'd rather pay taxes now and avoid the uncertainty for the future and not have to worry about future tax rates. I don't want to deal with the requirement of minimum distributions or RMDs when I'm 73. I don't want to deal with my income tax rates increasing in the future because I want to pocket as much as I can for the dollars that I work hard for. Most people haven't accounted for future Medicare expenses, Social Security income, and having too much in a pre-tax investment vehicle may not be necessarily helpful for retirement planning. And this is why when I'm 55, I'm going to use the rule of 55 to withdraw from my traditional account and make Roth conversions as necessary. I know this was super far in depth, so I encourage you to look over your TSP statements to make sure you're doing what's right for your financial future.